Through a combination of different foreign economic zones, escalating war as tensions increase, the US Federal Reserve Bank not signaling a clear direction with their monetary policy, with global tariff tensions increasing as no deals have been finalized into law, it leads to a muted stock market. It leads to a muted ceiling that prevents risk assets from being able to expand and grow. I believe that all parabolic growth in risk assets, such as stocks and commodities that are in the risk-on basket, are all a function of money supply. Money supply growing globally is a function of what the Federal Reserve in the US decide to do as they open up the capital markets like no other economic zone. They reduce interest rates, allow money to be easier to borrow, cheaper to access. It all flows into the fastest horses, whether it's Nvidia, Amazon, Taiwanese semiconductor company, Meta, or if you choose to go into a commodity like Bitcoin or other cryptocurrency assets, or Tesla, they're all a function of M2 money supply expanding and economic certainty. I choose with these beta derivative plays which grow and perform faster than the indexes, the S&P 500, the biggest companies in the US. You can choose which one you prefer. Which one you choose to follow is a decision that you make based on your interests. In the famous words of the iconic investor Peter Lynch, owning stocks is like having children. Don't get involved with more than you can handle. Following one company or just a small handful of assets is enough for you to be able to understand if there is an edge, if there is a moat, if there is a unique selling point to this company. Are they creating electric vehicles and making a profit from the vertical integration that they have in the manufacturing process? Are they at the forefront of fully self-driving vehicles and the software required to be able to create autonomous driving? Are they at the forefront of energy deployment, which is going to be increasing in the future as AI demand grows? Are they at the forefront of humanoid robots? You need to decide based on your interests and based on your research within that company whether they are at the forefront of these growing S-curves, because your decision to own a company that is involved in these S-curves in a meaningful way is going to allow your investment to potentially grow and participate in this exponentiality that is going to happen within the next 5 years. This is one of my most important videos I've ever made. It's going to be data points that I've managed to collect over the last few months and also the ones that I believe will be relevant for the rest of this year. Investing importance, black swan events, Tesla's arbitrage opportunity, macro data, global certainty as things start to become clearer, and then Tesla's challenges, and then the robo-taxi signals, and what this launch that's imminent is going to mean for this business model going forward. So if you like content on investing, economics, macro trends, and in particular, the choice that I made in understanding Tesla as the company that I believe will expand and grow the fastest, like, comment, subscribe. Let's get straight into it. This first segment is so interesting and so important. It's investing importance. $1 invested in the S&P 500 30 years ago has grown to $19.29. Whereas if you'd held that $1 in cash, it would have eroded its purchasing power down to 47 cents. It just shows the importance of having your money work for you. But that also opens up another layer to this story. It's the actual cumulative returns. Now, out of 29,078 publicly listed US stocks from 1925 to 2023, it was like lottery winners trying to find the companies that are actually going to meaningfully contribute to the growth of this index. 17 stocks delivered 5 million% or more. Just 86 stocks have counted towards the 16 trillion of wealth accrual. That's half the stock market over the last 90 years. It goes to show that the handful of companies that actually make a meaningful impact to the growth of your portfolio are very, very, very hard to select. The Nvidias, the Netflix, the Amazons. And when you find one, it can truly meaningfully change your life. And so it leads to this next part, which is what has led to a trend of more passive investors, people who just leave their money dollar cost averaged into the indexes, and they're overtaking the active investors who actually manage and select particular stocks. Now, when that happens and you have this increase in passive investing, a lot more money is getting allocated at a weighted average towards companies that actually aren't growing meaningfully. And so those companies that are growing meaningfully, that are opening up new addressable markets, the price discovery of those assets is a lot harder and a lot more complicated because there's less people looking for them, less people making active investments in the companies like Tesla, Nvidia, and Amazon. Now, that could be interesting to paint the picture of how growth could look in a portfolio going forward into the next 5 years, but I still believe firmly that Tesla will still have the most meteoric rise of the Magnificent Seven and will contribute meaningfully to the S&P 500, just like those 17 companies that were lottery ticket winners managed to contribute meaningfully to the millions of percent towards the actual growth of the S&P 500. So it's really important to be able to select. And when you find a winner, hold on to it and let it run. Section 2 are black swan events and V-shaped recoveries. Now, in these moments where there's a global pandemic, there is war, or there's global tariff tensions, there's a massive capitulation event where the algorithms sell into the headlines and into the news and into this fear and into this sadness and into this pain. But usually that marks the bottom. And you can see within this data set that every single time that the invasion started, it marked the bottom of the market before it started to look forward. The Afghanistan war is different because at that point, even though it recovered immediately after the invasion, there were other macro events that happened that led to the market continuing a downtrend. The next part is the V-shaped recoveries, and this is where the S&P 500 has a waterfall sell-off. But there's only 4 occasions where actually after those waterfall sell-offs, the lows have been revisited. So you can see that in 1932, the low was retested. In 1962, the low was retested. In 1946, the low was retested. And in 2002, the low was retested. But of the other 8 events where the S&P 500 has sold off, the V-shaped recovery is almost immediate, and you never go back to those lows again, which points the direction for the potential direction the market goes for the rest of this year. Another really important data set that can give you an idea of where the rest of this year goes is the 200-day moving average, the green line. When the S&P 500 corrects and bounces off that line, so this could signal a $7,000 S&P 500 price target by the end of the year. Section 3 is Tesla's arbitrage opportunity, where this company follows historical patterns of outperformance. You can see that from June onwards to the back end of the year, this average shows that Tesla's actual performance happens at the back end of the year. You can see here from its IPO, the best months for Tesla seasonally are June and also in November, where it has double-digit months. Retail investors managed to get exposure to the Tesla fund on the most recent pullback by millions of dollars worth of shares, which means that they're seeking out an opportunity and they can start to see what may happen by the end of the year as these new products start to open up, like the robotaxi launch. You've also got a data point that's starting to open up an opportunity for the electric vehicle business for Tesla as the electric vehicle business in China starts to break down. The Evergrande moment in the housing market in China, when the collapse of the value came from a massive amount of houses and not enough buyers, could also be the case for their electric vehicle business as well. You haven't got enough buyers for the vehicles that they're manufacturing. They're not paying their suppliers. They're taking up to 180 days or more to pay back their suppliers, which signals that they're not actually cash flow positive, but they're state funded, and that's what's propping up these companies like BYD, Xiaomi, and Xpeng. That paints a picture for Tesla's actual foundational business, which is electric vehicles, as another opportunity for arbitrage. Section 4 is the macro data that allows this $7.3 trillion worth of money in money market funds to be unlocked. As the interest rate comes down, the money from this money market fund starts to be released into risk assets. Amazon, Nvidia, Meta, Tesla, Bitcoin, crypto assets. It will go there because that's where the alpha is going to be. That's where the growth will be. But until that interest rate comes down, the money is going to stay in those money market funds because it's comfortable there. It's attractive. Now, there are 2 data sets that I want to look at that make up the basket of how inflation data is analyzed by the Federal Reserve. The first is electricity, and that's showing that it's growing from 3.6% to 4.5%. This makes up 2.39% of the overall basket. Electricity is growing, I think, because of the fact that data centers are being built, More electricity is being consumed to support the AI infrastructure that's being developed across the world, especially in America. The next data set is housing. And housing makes up the majority of the basket, and it's delayed in the inflation data because you have a contract for a year, and that tenancy isn't renewed until the year is finished. Now, that is a lagging indicator. I believe with the surplus of houses, the actual housing impact is going to come down and bring the inflation data down as well, which will signal more cuts. The more cuts that we have, the easier it is to unlock this $7.3 trillion worth of money in money market funds, and that will go into all risk assets and it will rise all the boats. There will be outperformers, I believe Tesla, but it will rise all boats. Section 5 is really important. It's the global certainty. I believe that we're going to have a lot more certainty going into the back end of this year. There's a picture here that shows that after Trump left the G7 summit in Canada, the person who stayed behind is Secretary of the Treasury, Scott Bessent. That, I believe, signals a potential trade deal between Canada and the US because he is the chief negotiator for the trade deals. If that happens, that's going to create certainty in the market. The next, freight rates are on the move. They're starting to go back up again. That means that there is more business, there is more imports coming back into the US, there's more confidence in the market. That's also going to help, again, with consumer confidence and also markets love certainty. The next is the polymarket US recession going down and Bloomberg Economics global trade policy going down as well. There's more certainty that there's going to not be a recession this year. And that is also going to lead to confidence in risk assets. Here is a quick snapshot of the deficit, the total receipts and the total outlays. The deficit is over 1 trillion. That means the government will have to print. That means the Federal Reserve will have to intervene and print. Therefore, more money will be injected into the economy, which will rise all assets. The 10-year yield, which is the best indicator for the future inflation rate, if that yield comes down, that means that the bond price is going up, which means that the inflation of the future that people are worried about, that concern, is also starting to come down. So the yields coming down is certainty coming back into the market. And one of the most useful and accurate indicators is the ISM, the Institute for Supply Management. Now, when it hits these lows, it usually has a V-shaped recovery and it starts to go back up again. When it goes up, that means that there's growing confidence in the economy. People have more money. There are going to be more people hired. There's going to be more money in people's pockets, and that money will then find its way into risk assets. Another snapshot of just the history that can help you understand the growth that could be expected in the future. There are 5 really important data sets here. The COVID shutdown, companies managed to survive. The bullwhip supply chain, companies managed to survive. Inflation rate, the companies managed to survive. Fastest Fed rate hikes in history, the companies managed to survive. Tariff global tensions, and companies managed to survive. I believe that companies have been battle tested to be able to prepare for what could be the golden era to the back end of 2025, going into the first quarter, second quarter of 2026. I'm going to keep this part short, but it is segment 6, and it's Tesla's challenges. Being an investor in Tesla is hard, but wherever you are going to have asymmetric returns, you are never going to feel comfortable investing in this asset. There's always going to be disruption. And with disruption, you're going to have the news feed on that. They're going to create extremely scary headlines, and you're never going to be able to avoid them. They're just going to be there. But it doesn't mean that the signal has gone. And the signal is the growth and in the business that's developing underneath all of that noise. Owning stocks is like having children. Don't get involved with more than you can handle. The decline and fall of Elon Musk. Elon's coverage across news networks is 96% negative. You open up the app on Apple and you'll get non-stop negative headlines about the EV sales declining in Europe. Elon's on drugs. It's never going to stop because this company are disrupting so many different businesses that exist, these legacy companies that will potentially go bankrupt if Tesla's businesses explode. Now, the main part of this video for Tesla investors in particular is the robotaxi and its signals. What this company are going to manage to produce and achieve and execute this year. So this is the part where you can see on the 22nd of June, this Sunday, the robotaxis launched. There are already robotaxis going around, Model Ys that are being used autonomously, driving without anyone in the driver's seat, and they are being trialed. They're going to do it slowly because they can then ramp this up very quickly because they already have the cars and they can just add to this network with existing Model Ys. So it is going to be tentative, but that's actually a good sign. They are currently established as an AV operator in Austin alongside other companies like Waymo. But how I look at Waymo is like this picture. Waymo represent that LiDAR legacy technology, geo-fenced, stuck to a certain region, map technology where they have all this expensive sensor suite attached to the outside of the car, rather than the actual fundamental first principles of driving, which is fully self-driving software where you have cameras that act as eyes, which is what Tesla represent, the dragon in this picture. Currently, you've got Waymo cars that cost $180,000. They require radar, cameras, and AI. And then you've got a Tesla Model Y, which can be used in this robotaxi network immediately, that have neural end-to-end networks that cost $37,490. And it's just vision, just like a human. It's just vision. And it collects that data and improves and continues to grow and continues to become more sophisticated at all of those edge cases that it faces and manages to navigate around. The progression of Tesla's robotaxi company is going to continue as they actually build a car that's even cheaper at $30,000, which is just, again, vision only, no steering wheel, extremely easy to make, and the cost of goods so low that they can make so much money selling these vehicles to the public and also having them work within this robotaxi network. Continuing to look at the data that shows that this business model is going to potentially be a great success is when Waymo 2 years ago went into San Francisco, they actually started to take over 25% of the share of ride-hailing services when Uber and Lyft were already there for considerably longer. It shows that self-driving and autonomous vehicles are actually what the market wants. Elon just signaled that this is a money-making opportunity as confidence in the robotaxi launch decreases. As soon as he made that statement and commented on that tweet, the increase in confidence went from 14% to 25% to 66%. There is a chance that Tesla have 3 types of ramps: a slow, an expected, and a fast. And if they have their fast ramp, they could have, by the end of the year, 2,700 vehicles operating across Austin and San Francisco and LA. This will take over the market within these areas almost overnight. But this is just the start. And this is the asymmetric opportunity of this year, next year, and the rest of this decade. Just like within the S&P 500, only 17 companies really meaningfully made growth within the index, Tesla could be starting the next lottery-winning opportunity. Could it be relevant? I want to look at this first chart, which shows that after key events, Tesla usually builds up and the stock performs well. And then after the event, it has a decline. But that's always short-lived because it recovers. So after a launch that's been publicized, it could mean that the stock's going to have a downfall, just like with any sell the news event. However, it does recover. And as the business starts to generate revenue, that's all that's going to matter in the long term. This is a really interesting chart of just technology in general and how every single trend line here, from telephones to radios to microwaves to the internet, they all start slow and people don't believe that this could happen. And then they have their meteoric expansion where the adoption rate just increases and compounds. And this could be a signal for what fully self-driving autonomous vehicles across a few states in the US could be before it has that full complete adoption across the whole of the US. Another reminder of what Tesla's business plan is and why it's got an opportunity to really dominate over the next few years. They started off with electric vehicles. They moved on to fully self-driving. That's where we are at the moment. They're growing and expanding their energy deployment megapack business across all the economic zones in the world, Australia, Shanghai, the US, and Europe. And then they're also building Optimus, their humanoid robot that they can scale and manufacture cheaply in a completely new market that's going to be potentially up to 100 trillion because it's a labor industry that will be disrupted. It shows that this company could be the leader. And I wanted to finish off with this picture. It made me laugh. AI is going to replace you. I'd love to see AI drink 6 beers before 11 a.m. in Spain. I'm very positive about the future. I love how humans adapt. I love how when you start to see that as technology improves our lives, it opens up other opportunities for businesses. Businesses that we just don't know exist. 50% of the jobs that children in primary school are being prepped for don't exist yet. That is the future. The innovation, the creativity that we're forced to go on the journey of completing is what awaits as this technology starts to improve our lives and make life more efficient. So if you got any value from this video, please like, subscribe, drop a comment down below. Tell someone about this video because honestly, I just get so excited about the future. I'll see you in the next one. Thank you very much.